Alright guys, what is up? Hive here really quick with another quick video on entries and exits. I'm going to go ahead and briefly just go over entries and exits based off of support resistance level and psychological levels, which you could go ahead and catch up on the previous webinar, which is up. It is over an hour. It's kind of lengthy, but it is very valuable information. So I'm gonna go ahead and jump right into it. I was going to briefly touch up on that previous webinar with the resistance support levels, though all due to that file being corrupted and it taking over an hour for me to make, roughly 30 minutes I should say. I don't know, I forgot, but I'm not going to go into it again. It's getting kind of late. Don't feel like staying up crazy late tonight again. I got plans tomorrow. So quickly, we're going to go ahead and add our support resistance levels, right? Sorry for the silence. I'm just trying to get these in, if you know what I mean. All right, so we got some quick levels. Well, not they're all going to be perfect, of course. I'm kind of, just saying them out. So when it comes down, we got a downtrend example. So we're going to go use bearish entries as an example. So once you have your support line marked up, we're going to use that as a entry for our put play, or if you're shorting, whatever it is, however your trading style is. Once the support is broken, you're going to want to enter your trade. Now, it's not just broken like this. What I mean is a candle opened above our support level and closed below it. That is a good entry sign. For bullish call plays or buying, you want for it to open below the resistance and close above it, such as this candle did. Now, why this didn't continue is due to the lack of volume or buying power. Not necessarily buying power, but due to the lack of buying. So you're always going to want to wait, and you're always going to want to set your stop loss. Otherwise, you get burned like crazy. That is always why it's important to have a stop loss and then watch the support for a possible reversal, or in case it just bounces and or consolidate. Now, what's to stop us from knowing this was going to be a fake out? Well, you got it coming back to our entry level, right? You always want to keep stop loss at entry if possible. And well, it came up, came back down, and it broke it, and clearly it wanted to go down straight. Now, that's not going to be clear to someone who's a new trader, new to technical analysis, anyone who's new in general. So for someone who's new to this, how can you identify when to enter and exit a trade accordingly in your favor without being faked out like this? Now, indicators do help, but without indicators, a way you would look at it is the low price action and the clear indecision within these wicks, and an immediate reversal for you to exit your trade, especially with such strong bearish bodied candles and the small wicks. That means that selling is in a strong, more clear favor compared to these previous two bullish candles we have here. Now that's one way of doing it. Now when it comes to entering your trade, right here we have a clear open before the support and a close below it. That is our entry. Now it is normal to wait about 5 minutes, or you could jump right on the gun, or just size in small first and then add on as it goes. So when a candle opens below and closes above, or vice versa for your trend, your support or resistance is going to be your entry signal, right? Now, without using indicators, how are we going to exit this trade? Well, we're going to go ahead and use previous support levels from the previous week, from earlier in the week, earlier in the day, yesterday, the day before, 2 days before, whatever it be, off of a 4-hour time frame, a 2-hour time frame, 30-minute, or any psychological levels, which would be anything flat based, moved by 25 cents. So let's say 140, 140, 50, just clear psychological levels. Just because that's how the human brain works, that makes more sense to us rather than an odd number being, for an example, 147.07 or 140, 136.89. What a random level to put resistance, but hey, that's where it's at instead of 137. So what you're going to do is you're going to want to look for any signs of bullish candles for a bounce off of the support levels or resistance levels, depending on your trend. Again, we are talking in favor of I'm going to be talking in the bias of a downtrend because that is what we're looking at here. So what you're going to want to be looking for is any strong bounces off of support levels, whether they be tested or broken or rejected. Right here we have it testing. You can see it bounce off support level. What you're going to want to watch here carefully on these uptrend is how it's going to respect that resistance and whether buying power is truly picking up again, allowing for that to break out. Now, if it were to break out, we most likely would have seen it come back up to this other the resistance right here, and start most likely trading in this channel or completely going back up in the uptrend. Ideally, for Roku, you're gonna want to get out at 139 if you did enter. If you're already down here around 135, 136 area, you should have some pretty good profits on that $3 down move down. So no offense, you'd be an idiot to not take profits if it clearly broke out of its downtrend and went back up. You'd be a complete idiot. That's just that. I don't know how other way to put it. There's really no nice way to put it. Sometimes people just need the blunt truth and honest and a slap to the face. And my slap to the face is you're an idiot if you hold it on the reverse. So moving forward, now if you see that happening, you're gonna want to exit your trade and secure your profits, right? But since we see a clear rejection right here and buying pressure slowly decreasing with low volume, it's okay to add to your position, take profits, or just hold for this lower dip. Once another support level is broken, it is going to be clear that it's going to test another support level or new lower lows. Again, lower lows and lower highs is what we want in a downtrend, and higher lows and higher highs in a uptrend. So that is how you're going to identify your entries and exits. Whether the candle opens and closes prior to the entry level, which whether that be support resistance, and if it could close below or above it, depending on the resistance support level. But typically, you want a close before and you want an open before and a close after your entry level. And you're going to want to continuously see that on the next level, next support or resistance level, continuously throughout the day to dictate whether you're going to hold your trade, add, or take your profits or cut losses. So an example right here for continuation is we see the open before and close after. We can see a slight open right here and a slight close after, but we can see a solid close on the candle before, so that's another way of validation. Don't always recommend using that as validation. But the fact that it didn't reject and it just opened going into the next candle is a really good sign. So that's one way of doing it off of entries exits. Now, when it comes to adding indicators, we're going to use what's most commonly used, which is going to be the 9 EMA and the 21 EMA. Now, the way this works is when the 9 EMA, which I have marked right here as my pink line, just to show you that right here, you can see it is pink. I have my 21 EMA as the white line. When a 9 EMA crosses downward on a 21 EMA, it is a signal for a bearish downtrend. And as you can see right here, the 9 EMA did cross downward the 21 EMA. We could see a clear downtrend. But when the 9 EMA crosses up the 21 EMA, we get a uptrend. And here is a perfect example of that. The 9 EMA, again, it is pink, and the 20 EMA is white. 9 EMA crosses up to 21 EMA, and it continues its uptrend until it begins to consolidate. Now, these are the two easiest ways to dictate your entries and exits based off of resistance support levels and the most common used intraday EMAs, which is 21 and 9. These are just simply called EMA crossovers. There are multiple sorts of different EMAs, but 9 and 21 or 8 and 21 are the most common used when it comes to finding entries and exits. Excuse me. Sorry, I had to sneeze. When it comes down to your intraday trade, you could use them as swings. I just personally don't use them as swings. I like to use other indicators and just different methods and strategies for my swings. As you can see right here, we have a lot of choppiness with the EMAs, and that is why, because you got a downward cross, you got an upward cross, downward cross, etc. And that is why I prefer only using these two EMAs, 8 or 9, and the 21 EMA for my intraday trades and scalping. Hopefully you guys found this video beneficial. If you have any questions, please DM me on Skype if you know me. Again, Hive, HIVE, or leave a comment and I will try to get back as quickly as possible. Happy trading, everyone.